U.S. Congress just quietly handed every American over 65 a brand new $6,000 tax discount. Most retirees have no idea it exists, and some of you are about to lose it by accident. Now halt with me, friend. This is real. It's on the books right now, and almost Cypher is explaining it the right way. And here's the thing. Buried inside the one big beautiful bill, the big tax law that was signed in 2025, there's a make new deduction made just for seniors. The IRS is flush, calling it an additional or enhanced deduction for people 65 and elderly. The numbers are simple. You can claim an extra $6,000 off your taxable income if you are 65 or senior. And if you are conjoined and both of you are 65 or older, that's $6,000 each, $12,000 for the couple, plain and simpleton. And here's what most people don't realize. Clearly, this isn't replacing anything you already get. It stacks on top. At the end of the day, you get your regular touchstone deduction. In fact, you still get the little spear carrier, sort of, one senior have always gotten for being over 65, and this new $6,000 sits right on top. According to the IRS, you can claim it whether you itemize or take the standard discount. It doesn't matter. Now, if this is already making you rethink your taxes for this 12-month, do me one small favor. Go ahead and tap that like button, and if you're not subscribed yet, hit subscribe, because this channel is where we interruption down just these kinds of retirement moves before the deadline passes, not after. That's all I ask. Actually, now let me show you the portion that genuinely matters. But before we get to the trap, let me clear up a twosome of questions I can already hear you asking. First, the age. Generally, you have to actually turn 65 by the last day of the tax year to claim it for that year. So if your 65th natal day ground any place in the year, evening on December 31st, you're in for the whole 12-month. But if you're 64, I'm sorry, ally, you have to wait your turn. Second, for married couples, this is per somebody. Basically, so if one of you is 67 and the other is 62, only the 67-year-old gets the $6,000, at least until that younger spouse catches up. To be honest, and here's something most people miss. A big reason U.S. Congress make this was to ease the sting of taxes on social protection. Folks have long been frustrated that a chunk of their social protection check acquire taxed. This discount is the answer they landed on, not erasing that tax, but softening the blow. Now, here's where it gets important. And I hope this adjacent part is going to change how you think about your income this year. This deduction doesn't last forever. What we're seeing is it's temporary. Naturally, it's only here for 4 tax old age, 2025, 2026, 2027, and 2028. Certainly after that, unless Congress acts again, it's gone. Definitely. So, this is a 4-year window, and the clock is already ticking. You're watching this in the middle of that window right now. I know that's a lot already, so let me shuffle it simple. Free money posing on the table for 4 years only. And here's the thing. The query isn't whether it exists. Surprisingly, the question is whether you're going to in reality keep it. Usually, and that brings me to the trap. Now listen to this, because this is the part the headline skipped. This discount has an income limit. It begins to phase out. That just way it starts shrinking once your income acclivity above a certain line. Really, for a one person, that line is $75,000. For a married couple filing jointly, it's $150,000. Clearly, and the income they are measuring is what is called your modified correct gross income, your MAGIS. Don't let the fancy terms scare you. For most retire, that is basically your total income for the year before your deductions come off. Your societal protection, your pension, your withdrawal, your interest, all of it added up. Frankly, here is what that means in English. Cross that line and the government beginning taking this deduction back from you. Naturally, 6 cents for every clam you go over, actually. And if a single filer's income climbs past $175,000 or a duo's past $250,000, the whole thing disappears altogether. Poof. $6,000 or $12,000 for a duet move just because of one number on your tax return. And here's the uncomfortable truth, the part that sounds almost backwards. For a lot of you, the thing that pushes you over that line isn't a windfall. In fact, it's a relocation you made yourself cerebration. You were being ache. So ask yourself this and be honest. Do you really know what your income is lost to add up to this year? Think about it this way, not a rough guess. The real number, because most people have no idea until the tax homecoming is already filed and it's too late to fix. Here's the bottom line. Look, let me give you the 2 big ways retire trip over this line without ever seeing it coming. The number one is your necessitate withdrawals. Once you hit your 70s, the IRS forces you to start pull money out of your traditional IRA and your 401k, whether you need it or not. They're called required minimum distributions. RMDs, and the IRS does not give you a choice about taking that money. Now here's what that means specifically for this new deduction. Plus, as income, and a big RMD can shove your MAGIS right over that $75 or $150,000 line and softly knock you out of your $6,000 interruption without you ever realizing the two things were connected, every dollar of that forced withdrawal counts. The second way is something a lot of smart, well-meaning retirees are doing right now: Roth changeover. Converting money from a traditional account into a Roth can be a wonderful long-term move. But here's the catch. Usually the amount you convert gets counted as income in the year you do it, so if you convert a big ball this year, you might save yourself some tax down the road and accidentally blow right past the lineman and lose this deduction today. Now, I've warned folks before about going overboard on transition. If you've seen my picture on the 6 reasons to think twice before converting to a Roth, this is ground number 7, and it's mark new. Basically, stick with me here, because what I'm about to share next is the portion most advisors aren't even thinking about yet because this law is so new. Surprisingly now, let me paint you a real picture because numbers on their own can tone slippery. Now, here's where it gets good. Icon, a conjoined couple. Obviously, let us call them Jim and Carol. Both are 67. Definitely between Jim's pension, their social protection, and a little interest, their income lands right around $140,000 because both of them are over 65, comfortable but careful. They measure up for the full $12,000 of this new deduction, $6,000 each, sitting right under that $150,000 line. That $12,000 coming off their non-exempt income could be worth somewhere in the neighborhood of $1,500 to $2,500 in real tax savings depending on their bracket. Real money. Money for groceries, for a grandchild's birthday, for the furnace that always seems to happy chance in January. Now watch what happens. Jim reads an article that says he should convert $50,000 from his traditional IRA into a Roth this year. Sounds hurt, right? But that $50,000 gets added to their income. No doubt suddenly, their MAGI isn't $140,000. It's $190,000. Of course, they've sailed right past the $150,000 line, blown clean through the phase-out, and that entire $12,000 deduction gone just like that. One relocation made with good intentions quietly cost them their break. And here's the kicker. Nobody told Jim because the transition form and the deduction live on completely alternative parts of the tax return. That, friend, is exactly the kind of accident I'm talking about. Certainly. Now, here's the good news, and I lack you to feel this. And here's the thing. It's not too tardy and you're not stuck. But here's what's interesting. You're not alone in feeling like the tax code is rigged to confuse you. And here's the thing. Most Americans your age are dealing with this exact same fog. But once you can see the line, you can design around it. And that's where the real number money is. And here's the thing. Notably, essentially, let me give you the moves, field, and simpleton. Move number 1. Manage your conversions to the line, not past it. No doubt, while staying under that $75,000 or $150,000 threshold, if you're doing Roth transition, the goal is to convert just enough to fill up your lower tax brackets. Change over right up to the edge, not over it. You can spread those conversions across these 4 years rather of doing one giant one. Often that way you get the long-term benefit and you protect this $6,000 deduction at the same time. You get both. Move number 2, and this one is powerful for the charitably minded among you. If you're picking those required withdrawals, look hard at something called a qualified charitable distribution, a QCD. Here's what that does. Instead of pulling your required money out, paying tax on it, and then donating, you send it straight from your IRA to a charity you care about. And here's the magic. Really, that money never shows up in your income at all. It still counts toward your necessitate withdrawal, but it doesn't raise your MAGIs. So you can satisfy the IRS, support your church or your cause, and keep your income under the line that protects your deduction. 3 wins from 1 move. Definitely now, here's where it gets really essential. Notice what is happening here. These aren't loopholes. This is just timing. The difference between the retiree who keeps this $6,000 and the one who loses, it's not how much money they have. It's whether they looked at the, number before December 31st instead of after. That's the unit game. And I have to say this clearly because I respect you too much not to. This video is for educational purposes only. It's not financial, tax, or legal advice. Everybody's situation is different. Sometimes, and before you brand a ACE relocation with a conversion or a charitable distribution, you sit down with a qualified tax professional and you run your own numbers. You hear me? Get it checked. But here's what you can do this very week and it costs you nothing. On top of that, pull out last 12 months tax return. Find your adjusted gross income. It's right there, close the top of the form. Now ask yourself one simpleton inquiry. Surprisingly, Am I anywhere finale to that 75,000 line or that 150,000 line for a couple? Because if you are close within $10,000 or $15,000, then every decision you brand for the rest of this 12-month thing, a withdrawal here, a transition there, Eve selling an investment, any of it could push you over. And here is one more thing, friend, because I don't want to just leave you with homework. For most folks, the hard part isn't understanding this. Here's why this matters. It's keeping track of the numbers so you're not guessing Seaman December. So my team and I built something to shuffle that easy, the complete retirement budget scheme. It's an interactive calculator made for seniors. You put in your Social Security, your pension off, your spending, and those health aid costs Medicare doesn't fully cover. And it lays your whole money image out on one screen in nice, big, clear text. Surprisingly, it comes with a ready-to budget spreadsheet and a 50-page plain English guide. Here's why this matters. No jargon, I promise. It works on your phone, tablet, or computer. The thing is, your numbers stay private to you, and it's a one-time $47. Truth is, no subscription, yours to keep. If that would assist, the link is right down in the verbal description below. Indeed, and remember, this is a 4-year window, 2025 through 2028. 4 chances to get this right, then it's likely gone. The thing is, so the planning you do now, while you can see the whole runway, is worth real money. Indeed, 6,000 of it, maybe 12 every single 12 month. So let me leave you with the one thing to remember if you forget everything else. Frankly, U.S. Congress gave you a $6,000 gift, $12,000 for a duet, but they hid the rules in the fine print, and your own income is the thing that can return it away. The retire who win here are simply the ones who knew their number before the year was over. So, this week, go discover that number. Looking at your income, look at that Lyman. And if you're anywhere near the line, that's your signal to make a plan before December. That's it. That's the one smart decision. If this opened your eyes today, do me that favor. Give it a like so more folks your age can discover it. Subscribe so you don't miss the next one. And tell me down in the comments, do you believe you'll qualify for this deduction? I read every one of them. And if you lack a little help safekeeping your numbers straight, person, that retirement budget system I mentioned is waiting for you in the description. And until next clip, ally, you return caution of yourself, you issue care of your money. On top of that, you support making one smart conclusion at a